Meanwhile, there's an odd dichotomy here between plunging investor confidence and the amount of cash that's gushing into this stock market. Individual bearishness, that's plunging, and of course down to 22% bullishness rather. The fear gauge moving closer toward extreme fear. So how can we come to grips when we're personally growing fearful, but you still want to stay in this market? Believe me, I know it's not easy. So let's bring in our market experts, Alan Boomer, Scott Martin, and Mike Lee. You know, one of the reasons I've been bullish beyond the fundamentals is all the cash on the sidelines. Global investors took $62 billion out of money markets. They put $51 billion into stocks, $46 billion of that into U.S. equities. So, Mike, is this a reason you think for people to remain bullish?
Absolutely, Charles. I think any dip should be bought. I think the amount of cash on the sidelines is staggering. You have $4.5 trillion in money markets. You have over $700 billion of buybacks announced. And just keep in mind, okay, when that fear and greed index is up in the 80s and 90s, that's when you want to sell. When it gets down here, this is where you want to buy. And now it's easier for me to say it than to do it, but that historically proves the way it is. When everyone's calling for a correction, that's when you want to be a buyer.
You know, Alan, you were a VP at Goldman Sachs, and then you started your own firm in 2013. Wasn't a really great time, right? Most people hated Wall Street back then. So what's the secret for you when you get investors to remain calm, invested, particularly when they become fearful or distrustful?
I hate to say it, Charles, but you got to tell them to turn the TV off sometimes. You know, really focus on the long term. You know, why are you investing in the first place? Is it because you want to, every minute maximize your wealth, or is it to really maximize your wealth over time? What are the things that you're looking to achieve? Like, do you want to, retire one day or leave money for your kids? Like, days like today, weeks like these last few weeks aren't really going to matter in the long run. You've got to keep folks focused on the big picture.
Right. Scott, the amount of options, I'm going to get back to this old triple, quadruple witching thing. The amount of options in this market, it's got a lot of people concerned, right? They're saying it's really starting to skew underlying share prices. Also, it's making people less respectful of risk. What are your thoughts about that?
It's wild, Charles. It's definitely kicking up volume. I think it's an opportunity, like the guys have already said. I mean, any kind of drawdowns that we see because of options expiration or people, say, repurposing or recalibrating their portfolios, if you're getting pullbacks in names that you like, say like airlines or restaurants, anything tied to the consumer, you've got to use those pullbacks, whether it's triple witch or not, to buy in and fortify your positions.
So then let's talk about Resolve, market Resolve. Again, for the most part, it's been with us since 2009 on full display March of last year. This year, the S&P 500 has been holding that 50-day moving average like a champ, not just holding, bouncing off it like a trampoline. So Mike, you've expressed a tremendous amount of bullishness. What happens if the 50-day fails and we start to accelerate to the downside?
Yeah, look, I don't see any sort of acceleration from that. And again, I would be a buyer on it. And I'd start selling fixed income or finding other assets and other places to put more money to work. There's so much cash on the sidelines, combined with the fact that while the rate of change may be slowing, we're an expanding economy. This is a bull market. These last for years, not months. Markets don't sell off because of valuation. There needs to be a catalyst for there to be a meaningful correction. And I'd say the more selling we get, the less likely the Fed is to be active, which in my mind is the only threat to the market at this point.
I do believe the Fed is hostage to the stock market. I think they've created a monster they will not be able to control other than keeping it going. Hey, let's switch gears. We've been talking about stocks, but don't look now, but that 10-year yield is really starting to build some momentum to the upside. It's right on the cusp of a big resistance point. Now, Scott, I know you like the financials, and you talked about them. Obviously, they should do well as these interest rates are going up. Is this one of the areas to be in if we start to really break out?
I think so, Charles. And we own JP Morgan and Citi. We have for about a year now. We like the upward sloping yield curve, as you pointed out. Also, the fundamentals on those two stocks are very good. So if you're looking to, say, expand your portfolio, looking at financials, I think those are the two top names. But obviously, you can't probably go wrong too much with Wells Fargo, given some of the pressure it's had recently. But financials going forward here are going to take advantage of that upward sloping yield curve as the banks benefit from net interest margin expansion.
Right. And of course, if Elizabeth Warren gets her way, if you buy Wells Fargo, you'll end up with two companies for the price of one. Hey, Alan, at what point will these higher yields change the way you're investing right now?
Great question. I mean, I also like the banks. I like the regional banks as well as kind of the mega cap banks. You talk about JP Morgan. They made a lot of really good, powerful portfolio of businesses inside of JP Morgan. I like Citizens Financial, but rates are going higher. I don't think they're going meaningfully higher. Like I predict in the next year, you'll probably see a 10-year around 175. Like that's not enough to really, turn us away from anything, right? So I think rates will go higher. It'll be a grind higher.
That's like predicting the Knicks will just miss the playoffs. So I'm with you on that. Okay, let's move on to gold because I got to bring this up. We talked about inflows. Well, guess what? $37 million went into gold. It doesn't sound like a lot, but that's the most in 5 weeks. I got to get back to you, Scott. For a long time, you've been telling us you got to be in gold. But is it time to throw in the towel in the sense that this is your best hedge against inflation?
No, not yet, Charles. I mean, we like gold, and we have for many years because it's not stock and it's not fixed income. You mentioned the inflows on gold. It's actually had a pretty rough week given those inflows. But the reality is this. As I think interest rates starts backing up, I think as we see like maybe a little bit of a taper actually in inflation, that actually might help gold here. So we're actually adding it to our portfolios to build out that position a little bit higher.
All right, let's talk about what you're buying, Mike, because you got us pumped up, my man. We're in a secular bull market. Nothing's going to stop us. May hit a speed bump here and there. How do we take advantage of it? What's new in your portfolio?
So, hey, Charles, I'm on the other side of this interest rates. I think interest rates are going to back up here. Maybe we get a little bit higher, but then they eventually rally. Like we're in a low growth, low inflation world. So I just added some utilities on that trade, just as a low rates trade, as a kind of conservative anchor to my equity portfolio. And I also added a big position in REITs. I think the REIT sector, it's done really well, but I think it's going to be one of the last legs of this recovery. And I think the lower for longer, low interest rates really help them lever up and rebuild themselves.
All right. Utilities. I mean, you're a brave man. There's one utility I like, NextEra, NEE. I tell everyone, when Biden was elected, buy that stock. It did terrific under President Obama. All of these things they're trying to do means cash in their pockets. But it's a tough one, although defensive halves look pretty good over the last few weeks. All right, real quick, I think I've got enough time, 30 seconds, Alan. Last time you were on, you mentioned FedEx. I don't think we'll get a chance to talk before they report. Acting so-so. Stay the course there?
I love FedEx. It's linked to e-commerce. All the stuff that you order that comes to your house, a lot of it comes from FedEx. UPS is another great name, but FedEx trades at a 24% discount on a valuation basis to UPS. So whether the earnings are good or not, and I do think they'll be good, I think FedEx is a great position to own.
All right, gentlemen, let's leave it there. Alan, Scott, Mike, have a fantastic weekend, guys. Joining me next, Larry Kudlow.